What is going on, everybody? It's Alex here. And oh man, we got some news today. So, today I want to talk to you about the stock market. Again, behind me, I have my favorite brand in the world. That's here. That they don't talk about this thing anymore. It's weird. That's a Tesla Roadster, and it's weird. They stopped talking about it. So, anyway, today we got some CPI data. CPI data has to do with inflation. And let's see what happened in the morning. So, I have the report here for you. Let me change this up so you guys can see it. So the CPI data we were talking about, there we go, right here. Okay, so the CPI data, let me get to the report first, and then I'll talk to you about the other things. So that's the report, that's the PDF. I can link it down in the description if you guys want. So what do we have here? Here we got the inflation year over year, and then for the month of January. Now, it came worse than expected, which sucks. And that's why now we see a treasury yield 2%. It's crazy. That hasn't happened in a while. It's actually right now is at 2.21. Now, if this stays around these levels, that's gonna be good. If it keeps going up, we're gonna have some more issues in the stock market. But surprisingly, like in the morning, everything was doing good. Now that Nasdaq is going down, S&P 500 is going down. It's weird. What is Tesla doing? Tesla had a nice run in the morning. 9:31 is not bad at all. Like we started at 9:07 in the morning. Look at this. We started at 9:07. Let me see if you guys can see this. Yes, you can. All right. So we started at 9:07, and then kept going higher. Now it's dropping a little bit, but it's all right. So the CPI data, let's look through it. So for January, you have like 0.6%. They were expecting a little bit less. And then year over year, it came at 7.5. They were expecting 7.3, I think. That's worse than they were expecting. That is why we see some pain in the market. Now, what tends to happen usually, what you expect the stock market to do, it does the opposite. So this is an issue that's going on. Unfortunately, even if you make data-driven decisions, even if you try to time things perfectly, things are not going to happen 100% the way you think. Unfortunately, there's a human factor here, and it never happens the way you are expecting it to happen. So today, if you're to make data-driven decisions and see that the CPI data came worse than expected, you would think that the market would tank. It didn't. Now, from now, which is February 10th, till the first rate increase, which is March 16th. And now, here's the thing. People are asking for the Fed. Let me put the whole thing back to me so you guys can see it better before we talk about it. So, listen to this. As far as the data goes, March 16th, now people are putting pressure on the Fed to raise interest rates a little bit faster. So they were supposed to increase it for just 0.25%. Now they have to increase it for 0.5%. Now we don't know if it's going to happen, but that's the talk on the street right now. What is going to happen is that from now till March 16th, there is not too many negative catalysts anymore. And now you would think that this should push higher, and the stock market will push higher for the next month. Now, like I said, you expect one thing to happen and something totally different happens sometimes. So this is not guaranteed, but there is not too many negative catalysts. Now, what about my favorite company? What about Tesla? So Tesla has some positive catalysts coming their way. What are those? Well, we see some forms being signed. I'm gonna pull up this one. Let me find Gary Black's thing. This guy is a big Tesla bull. So if I pull Gary, let me see what Gary says. Gary Black. So Mr. Gary, talk to us about Berlin. Let me see, where is it? He was telling something about Berlin the other day. Well, the whole idea was, oh, there you go. My understanding is that mid-March opening first deliveries for Berlin is fairly accurate. Austin would be earlier. So you have two positive catalysts here. I don't think you guys can see this. Let me put it up so you guys can see what I'm seeing. So, there you go. So Gary's post right here. All right, let me zoom in a little bit. There you go. So says, my understanding is that mid-March opening first deliveries for Berlin is fairly accurate. Austin will be earlier. So the Gigafactory in Texas will open earlier than March. That's a great positive catalyst. Now, here's what's going to happen. We've seen this play again. Now, all these analysts, the moment that Tesla has the capability to produce more cars because they have more factories, now all of a sudden they're going to get upgraded. And now, here is what happens. Once they have these two factories up and running, even if each of them can make, like, let's say 500,000 cars, which is a good number to estimate, then you have a high cap company like Tesla that can double within a year. That's mind blowing. There is no other high cap company that has the capability of doing this. And then they're the forefront of electric vehicles. So that's great. So that's two positive catalysts for Tesla. Two more factories. Hopefully, within March, before March, actually, they're going to open the one in Texas. If this happens, Tesla should start moving upwards very soon. Now, so we talked about Tesla. What did CPI tell us? Let's take some big numbers here, guys. So let's see what sticks out of here. 39.9% year over year energy commodities. So energy is up inflation-wise 39.9%. Now you have to realize it's down a little bit in January. It's okay, but 39.9%. Energy commodities overall 27%. That's crazy. What else? Fuel oil, of course, 40%. I mean, you know what I was thinking? I'll show you stock market wise a move you could play to protect yourself, but I'm not a big fan of it. But I'll show you after this. So, what we got going on here is 46% energy services. Is that what it is? No, 46% is fuel oil. I'm sorry, energy services. It is just 13.6%. All right, 23%, all items less food and energy. Okay, you have something else sticking out here too. You see, it is 40.5%, and that is used cars and trucks. That's insane. Like, so here's the thing. That's what, so Jerome Powell, our sugar daddy from the Fed, what he's gonna do is, like, he's gonna look at these reports, and then maybe on March 16th, which is gonna be the first interest rate increase, maybe he's gonna be more aggressive. Now, that's gonna be interesting how it plays out, because you never know what they're gonna do. But so there is elections coming up, and even if they raise interest rate increases by 0.25% at every meeting, like 1% interest rates, they're not gonna hurt nobody. But let me show you how you could play this from the beginning that I was looking at and be safe. I mean, XOM, all right? XOM is down nothing percent, like 0.063. But look at this, all right? Look at this, green. Everything else in the stock market has been hammered. And then XOM, and then other companies with oil. There is so many oil companies I could look for, but these are similar. Chevron is here, is up 9%. We can compare. Look at this. Occidental Petroleum. Look, I'll add them all. Look at this. Amazing performance by all of them, you know. Marathon Oil. Look at this. All this is oil. All this is oil, and amazing performance. But you see, this is gonna be like the last kind of era that we see oil surge so much, because now everybody's putting focus on EVs and batteries and chargers. We've been over this again. So, you know, oil is doing good for now, but don't think that oil is gonna keep outperforming the stock market for a long time. For the next few years, maybe, you know, especially if you have Democrats in power. Like, unfortunately, this is what happens. The oil prices, they skyrocket every time, which is good, because if you know that you can play this that way and be safe. I wouldn't, and I'm not a fan of oil and gas and all these things. It's just not sustainable for the environment. But you could play this way and save yourself a lot of money. Now, I'm gonna compare these companies to Tesla and my favorite companies, right? So what if I do add comparison? Tesla, add comparison to, let me put, what other companies? Enphase, that I really like, smaller company. You know, look at this. All right. Now, Enphase and Did we add Tesla here? No. Tesla. That's the all right. Okay, you can have up to 5. That's why. All right, I'll remove Chevron, which is that up, and I'll put Enphase. You can compare up to 5. So Enphase Energy. Look at this. So down here, Enphase, and the blue one is Tesla. Look at how low they are, percentage-wise. All right. Enphase moved up a little bit because of the great earnings. Enphase is a great company. I cannot stress you enough. Enphase is an amazing company. They do chargers. If you look at their earnings, I'm gonna pull them up just out of curiosity to see what happened on expectations. But great company, just not the right time to be in it. So you see, oil outperforms the market for a while now. Outperforms, like I'm at the 1 month chart. Let's do the 6 month chart. And now it gets more complicated. So the 1 month chart, it's more clear because of the pain we've had. So these assets, they've been going downwards, like Tesla and Enphase, which is the yellow and the blue. And then right here, and then the other two, they've been moving higher, like everything that has to do with oil, ExxonMobil, Occidental Petroleum, Marathon Oil, all these companies, they've been moving higher. And it is what it is. But that's oil's last chance to make some money for their investors, because that's not where the future is moving. The future is moving out of the oil companies and into batteries, chargers, renewable energy, solar power, preferably. We're a little bit, we're a little bit back when it comes to this, but we're trying to catch up. Now, let me see what else we have to tell you. I'm gonna pull Enphase earnings so you guys can see. All right, Enphase earnings. There you go. Look at this. Look how beautiful that is. Q4 2021. Look at this. So surprised by 23%. So they were expecting EPS by 0.59. They got EPS 0.73. 23% beat. What an amazing company. Do you guys know many companies that they get 23% beat on EPS? Unbelievable. And then the revenue is higher too. They were expecting almost $400 million. They got 412. Enphase is an amazing company and healthy company, a company that focuses on the future. And yeah, unfortunately, like I said, in a high interest rate environment, like weird things happen that you don't want to happen, but it's healthy. Like you cannot have free money forever, So Enphase, another great company. That's why it moved so much higher. And the move is not too big like today because of the CPI data, like the inflation data, but 0.71%. But regardless, Enphase is a great company. You guys should definitely consider buying some when you see it cheaper. Now, what else I wanted to show you? We discussed about this. Let me see what else is going on the street about, what are they talking about? Bond market marched through 10-year right up 2% and stopped. As we said earlier, market seems to be adjusting to a new reality of the 2% 10-year treasury yield, with inflation likely to subside as the year progresses. In such an environment, positive earnings revisions will drive stock prices. So what this guy says, and I love Gary Black, he's such a Tesla bull and he's such a smart guy. Like if you see the stocks he does in his funds, like I agree with him like pretty much 100%. So he says the only factor that's going to differentiate good companies with bad companies right now is earnings and revisions on earnings. Now, does it mean that if you make money, you're a good company? Of course, no. I can tell you a billion companies that they make money and they're trash. But that's what is going to differentiate the good companies from the bad. So you have to stay in high caps, Google, Tesla, and stay away from risky plays that they don't make any money right now. Now, like I told you again, if interest rates, they stay at 2% and earnings keep coming this way because people spending money like crazy and there is nobody that can tell me otherwise, there is such a shortage of labor, and people tell you that this is a bad economy. There is such a shortage of labor right now and people pretend like things are shaky. No, that's a healthy economy. That's a good economy. That's the reason we need to raise a little bit interest rates, by the way, too. So it happens. You have to raise interest rates so inflation doesn't swallow you. And like I said, inflation always goes away and is self-regulatory. The question is how painful it's going to be. And now there's a painful months. Like we see the CPI reports, like I just showed you, and it's full of pain here. You see like 40%, 30%, 20%, year over year. It sucks, but it is what it is. Now, what else I wanted to tell you? It is the following. I showed you end phase. There is another play you can do. I told you would be safe in oil, but you just choose not to invest in it. Gary Black, let me show you what else. He just posted this recently. He made some really good on the money. Like some companies he invested in, they were great. That's what his fund invests in. You guys can see this, I hope. Yes, you can. Let me see if I can zoom in a little bit closer. You guys should definitely follow Gary on Twitter. So Tesla is his third position, like no doubt about it. Alphabet, he got this right. You see, he put Google, and Google is about to do a 20-for-1 stock split. By the way, that's why I think he put it up there. But he believed in Google before everybody else. Harley Davidson had a great earning season. Chipotle was great. That's what he says here. And phase two. So these guys' picks are good. You guys should follow this guy on Twitter and look what he says, because what he has to say is important things. Now, let me put it back to me and tell you a few things. You people that are here, thank you for being here. And I'm going to keep it short. Okay, so what is going to happen now? That's the bigger question. From now till March 16th, that's going to be the first interest rate increase. We should have some positive catalysts for my favorite companies like Tesla. Google has the stock split happening. I don't know when it's going to happen, but it's going to happen. So we should see some good green days. After that, the waters are going to get more rough. Does it mean that you should cash out? I don't think so. Let's see how things go. But that's going to be a good decade, man. The 20s are going to be a good decade. And you can see this from many aspects of the economy. You can see this of how strong the demand for items is. You can see this by all these supply chain issues that they are not normal, because you see the supply chain issues come from the fact that all these people that they were closed up for 2 years, now they go out, they like purchase more than they had the need to purchase before. They do more because now we're back to normal pretty much. So what this means is that since we're back to normal, there is more demand because people have been closed up for years. So that's how you do it. You stay in it, like I told you in the previous episode. You stay in it to win it, and you invest in high cap companies. Google, Tesla, you cannot do wrong with those. I have a video. I'll try and link it maybe somewhere up here. You guys can see it. If you invested in Google like 15 years ago, now you had $10,000 in Google, would get you today like almost $150,000. That's your children's, college fund. A child is being born today. You put some money in Tesla and Google, you can pay for the college fund in 50 years from now. That's pretty much all I had to say today. Thank you, guys. Stay in it, win it. What is the company doing right now? What is the 10-year? 10-year is around the same levels, not pushing any higher. What are we doing here? What is the S&P 500? I'm gonna end with one last thing I want to tell you. Okay, the S&P 500. Do you guys? I don't think you guys can see this. I put it back to me. All right. The last thing I want to tell you. Here is the last thing I want to tell you. This is the S&P 500, right? This is the 500 companies in America, okay, that they are an index fund. Now, what I want to tell you about this, what is my plan? I might be right, I might be wrong, but I've been doing this long enough to like have a feel for it. Now, don't bet on my gut. If you guys don't feel comfortable, do whatever makes you feel comfortable. That's entertainment advice, not financial advice. I don't know. Don't sue me. That's my whole point. But my plan, I'm going to lay it out to you right now. It is to be out of the market once the S&P 500 reaches around 5,500. All right. This is, I think, once we're going to have 3 interest rate increases happen. I've made a video about this before. 3 interest rate increases, you're out. You're waiting on the sideline with cash on the side to pick up the scraps once there is a mess happening. All right. So once the S&P 500 reaches $5,500, you better cash out and stay on the sideline just in case. I might be wrong. That's my plan. But like I told you, 3 interest rate increases happen. Go watch that video that I made maybe a month ago. pain comes in the market every single time. Now, because of this higher inflation, there is pain before, and then the anticipation of the interest rates increase happening, and then you have all these new retail investors that they know how to handle this as well. So what you have to take away from it, keep an eye on the interest rate increases happening, how big they are each time. Are they 0.25%? Are they 0.5%? And keep an eye on the S&P 500. Nearby 5,500, you better store your cash. And it might run more than it. It might, and it's very possible it's going to run more than it before it crashes. But we're going to have a big correction again, don't rush. We're going to have a big correction, and then you can go back to it. But the thing is, 5,500, the S&P 500, interest rate increases, keep an eye on. And what I want to tell you as well, even there is an election year too. Remember that the election year, Biden doesn't want to go down as a person that crashed the stock market the election year. So don't think that he's going to do anything silly to crash the stock market once he wants to get reelected. So that's another factor you have to factor in. So lastly, 5,500, S&P 500, good caution for you, like a cushion to get out before everything goes to, down the drain and then goes back up again, because the 20s, like I said, are going to be a great decade. Well, once this happens, cash out, wait on the side, then pick the cheapest companies that you love. More Tesla. My price target for Tesla for this year is like 12 to 1400. So I think we'll do good if you invest in Tesla. But regardless, be cautious, keep an eye on the street, come back here, subscribe for more. I love you guys. I'll catch you guys on the next one. And let me get my Tesla whistle to greet you the right way. I love you. Smash the like button. I'll catch you guys on the next one.